While millions of Americans lost their homes, their savings, and their hope during the 2008 financial crisis, a small group of billionaires became dramatically wealthier, not through luck, not through insider information, through a strategy so simple that most people completely miss it. They bought 3 specific types of assets that always get cheaper during crashes, but never lose their fundamental value. Assets that people need no matter how bad the economy gets. Assets that generate income even when stock markets are collapsing and unemployment is spiking. Warren Buffett deployed $26 billion during the worst recession since the Great Depression to buy something most investors thought was completely insane. Bill Gates quietly accumulated massive positions in companies that others were desperately trying to sell. These weren't tech stocks or cryptocurrency or gold or any of the assets financial media talks about. These were crisis assets. Assets that have made the wealthy exponentially richer during every major economic downturn for the past century. Here's what nobody tells you about economic crashes. They don't destroy wealth. They transfer it. From people who panic and sell everything to people who understand what actually happens during recessions. From people who need cash immediately to people who have cash reserves waiting. From people who see crisis to people who see opportunity. And the transfer happens through 3 specific asset classes that behave completely differently during economic chaos than everything else. The first crisis asset is the one that every billionaire accumulates during market crashes because it provides something that stocks and bonds cannot deliver during economic uncertainty. Guaranteed monthly income from people who have no choice but to pay. Real estate, specifically rental properties, but not the kind of real estate that most investors think about. When the economy crashes, something fascinating happens to the rental market that creates massive opportunities for people with cash. Home ownership becomes impossible for millions of people. Banks stop lending, credit requirements tighten, down payment requirements increase. Suddenly, families who plan to buy homes have no choice but to rent. This creates what economists call inelastic demand. People need housing regardless of economic conditions. They need shelter whether the stock market is up or down. They need a place to live whether unemployment is 3% or 15%. During the 2008 recession, something remarkable happened that most people never noticed. While home prices crashed by 30 to 40% in many markets, rental demand actually increased. Rental vacancy rates fell to historic lows in cities across America. Why? Because millions of families lost their homes to foreclosure, but still needed somewhere to live. Millions more who planned to buy homes couldn't qualify for mortgages anymore. The demand for rental housing exploded precisely when rental properties could be purchased at massive discounts. This is why billionaires keep enormous cash reserves during economic expansions. Not because they're pessimistic about the economy, because they're waiting for these transfer moments when assets move from weak hands to strong hands, when people who are overleveraged and desperate for cash sell properties at 50 or 60 cents on the dollar to people who have cash waiting. Blackstone, the world's largest private equity firm, exemplifies this strategy perfectly. During the financial crisis, they raised massive funds specifically to buy foreclosed and distressed residential properties. They purchased over $15 billion worth of single-family homes at deeply discounted prices when desperate sellers needed cash immediately. Then they converted these properties into rental units, generating consistent monthly income from tenants who had no alternative housing options. Today, Blackstone owns over 300,000 residential units across the United States and has generated billions in profits from this crisis investment strategy. The mathematics are simple but powerful. If you buy a rental property for 60% of its normal value during a crash, your rental yield immediately increases by 67%. A property that normally generates a 5% rental yield suddenly generates an 8.3% yield, but the income doesn't stop there. As the economy recovers and housing demand normalizes, the property value appreciates back toward normal levels while the rental income continues flowing month after month. This creates what wealthy investors call a double profit mechanism. Income profits from rental payments that continue regardless of economic conditions. Capital appreciation profits when property values recover to normal levels. The combination has made real estate the most consistent wealth-building asset for billionaires during every major economic crisis. But not all real estate works as a crisis asset. The key is understanding which properties maintain rental demand during recessions and which properties become liabilities. Luxury vacation rentals collapse during economic stress because discretionary travel spending disappears. Commercial office buildings suffer when businesses close and unemployment rises. Retail properties fail when consumer spending plummets and stores shut down. The crisis asset real estate that billionaires target has 3 specific characteristics. Essential housing that people need, regardless of economic conditions. affordable housing that remains within reach of families with reduced incomes. Properties in areas with diversified economies that don't depend on single industries. Multifamily apartment buildings in stable communities consistently meet these criteria, which is why they represent the largest category of billionaire real estate investments during recessions. The rental income from these properties provides something that no other investment can deliver during market crashes. Predictable monthly cash flow that arrives regardless of what happens in financial markets. While stock dividends get cut and bond values fluctuate and businesses fail, rent checks continue arriving every month because people need shelter. This cash flow stability allows wealthy investors to maintain their lifestyles and continue investing, while others are forced to liquidate assets to pay expenses. Warren Buffett has repeatedly emphasized this principle in his investment philosophy. During uncertain times, focus on assets that generate cash flow from activities people cannot avoid. People might stop buying new cars during a recession. They might cancel vacations and reduce restaurant spending and delay major purchases, but they cannot stop paying rent because they cannot stop needing housing. The second crisis asset that has consistently made billionaires wealthier during every economic downturn might surprise you because it sounds boring compared to technology stocks or cryptocurrency or other high-growth investments. Dividend-paying stocks from companies that provide essential services. But not just any dividend-paying stocks. Stocks from companies that have maintained or increased their dividend payments during previous recessions. Here's why this asset class becomes incredibly powerful during market crashes. When stock prices collapse, dividend yields automatically increase for investors who buy during the crash. A stock that normally pays a 3% dividend yield suddenly pays a 6% dividend yield when the stock price falls 50%. But the actual dividend payment doesn't change. The company continues paying the same amount per share. You just get more shares for the same investment because the share price is lower. The mathematics create a compounding effect that builds enormous wealth over time. Higher dividend yields during the purchase generate more income immediately. Reinvesting those dividends at crash prices purchases more shares at discounted valuations. When stock prices recover to normal levels, you own significantly more shares that continue paying dividends at the original rate. Coca-Cola provides the perfect example of how this strategy works. During the 1987 stock market crash, Warren Buffett dramatically increased his Coca-Cola position when the stock price fell nearly 50%. The dividend yield on his purchase was over 6%, compared to the normal 3% yield before the crash. But Coca-Cola never reduced its dividend payments during the crisis because people continued buying soft drinks regardless of economic conditions. Consumer spending on beverages remained remarkably stable even when other spending categories collapsed. Over the following decades, Coca-Cola continued increasing its dividend payments annually while the stock price recovered and surpassed its previous highs. Buffett's crisis purchase generated billions of dollars in dividend income alone, not including the capital appreciation from buying at crash prices. The investment became one of Berkshire Hathaway's most profitable positions ever, demonstrating how dividend-paying stocks from essential businesses create generational wealth when purchased during market panic. The key is identifying companies that provide products or services with inelastic demand during recessions. Utilities that provide electricity and water that people cannot live without. Telecommunications companies that provide phone and internet services that have become essential for work and communication. Food and beverage companies that sell basic necessities rather than luxury items, healthcare companies that provide medications and treatments that people need regardless of economic conditions, and treatments that people need regardless of economic conditions. These companies possess what economists call recession-resistant characteristics. Their revenues decline minimally during economic downturns because demand for their products remains relatively stable. When household budgets tighten, families cut discretionary spending first. They cancel streaming services, reduce restaurant visits, postpone vacation plans, but they continue paying their electric bills, their phone bills, their prescription costs. They still need basic food products and household essentials. This stability allows these companies to maintain dividend payments even when other businesses are cutting dividends or eliminating them entirely. During the 2008 financial crisis, companies in the S&P 500 reduced their average dividend payments by only 2%. Meanwhile, stock prices fell an average of 32%. Investors who purchased dividend-paying stocks during the crash locked in yields that were 15 times higher than normal while collecting consistent income throughout the recession. Verizon exemplifies this defensive dividend strategy perfectly. During the 2008 crisis, when most technology and telecommunication stocks collapsed, Verizon's revenue declined by only 1%. People continued paying their monthly phone bills because mobile and internet connectivity had become essential for work, school, and maintaining social connections. The company's subscription-based business model with over 90% recurring revenue provided predictable cash flows that supported consistent dividend payments. While the overall stock market fell 55% during the financial crisis, Verizon's stock decline was limited to 35%. More importantly, the company increased its dividend payment during the recession, providing shareholders with growing income during the worst economic conditions in decades. Investors who bought Verizon during the crisis received dividend yields approaching 7% compared to the normal 4% yield, creating an immediate 75% increase in income generation. This pattern repeats across multiple recession-resistant industries during every economic downturn. Johnson & Johnson maintained dividend growth during the 2008 crisis because people continued buying healthcare products and medications. Procter & Gamble sustained dividend increases because consumers still purchased toothpaste, soap, and cleaning products. Walmart actually increased sales during the recession as consumers shifted toward discount retailers, allowing the company to grow its dividend payments while competitors struggled. The psychological element cannot be ignored when implementing this strategy. Buying dividend-paying stocks during market crashes requires tremendous emotional discipline because financial media coverage emphasizes fear and uncertainty. Headlines predict economic collapse. Analysts recommend defensive positioning. Every piece of news reinforces the narrative that investing during crashes is dangerous and irresponsible. But billionaires understand that maximum fear creates maximum opportunity. When panic selling drives stock prices to irrational levels, companies with strong fundamentals and essential business models become available at valuations that won't exist again for years or decades. The key is having cash reserves available during these moments and the psychological fortitude to invest when others are paralyzed by fear. The third crisis asset represents the most sophisticated strategy that billionaires employ during economic downturns, and it's the one that requires the largest capital deployment but generates the most substantial long-term returns. Infrastructure and utilities. Assets that provide absolutely essential services that society cannot function without, regardless of economic conditions. Roads, bridges, railroads, power plants, water systems, waste management, telecommunications networks. These infrastructure assets possess characteristics that make them nearly bulletproof during recessions. They generate revenue from services that people and businesses must use regardless of economic conditions. They operate under regulated frameworks that provide predictable returns and protection against competition. They require enormous capital investments that create high barriers to entry for potential competitors. They typically operate under long-term contracts that guarantee revenue streams for decades. During the 2009 recession, Warren Buffett made what many considered his boldest investment ever. He purchased Burlington Northern Santa Fe Railroad for $26 billion when freight volumes had collapsed and most analysts predicted permanent decline in rail transportation. Critics questioned why Buffett would invest in a 19th century industry during a modern recession. Transportation companies were failing. Shipping volumes had plummeted. The entire logistics sector appeared obsolete. But Buffett understood something that short-term thinkers missed. America's economy depends on moving goods from producers to consumers, agricultural products from farms to cities, raw materials from ports to factories, manufactured goods from production centers to retail locations. This transportation demand doesn't disappear during recessions. It temporarily decreases, but inevitably recovers as economic activity normalizes. The railroad acquisition demonstrated classic crisis asset investing principles. Essential infrastructure purchased at recession prices during temporary demand weakness. Monopolistic market position with high barriers to entry protecting against competition. Regulated industry structure providing predictable returns and protection against political interference. Long-term contracts with major shippers guaranteeing revenue streams regardless of short-term economic fluctuations. After the economy recovered, freight volumes returned to normal levels and continued growing as America's population and consumption increased. The railroad's revenues and profits surged beyond pre-recession levels, while Buffett had purchased the entire company at deeply discounted crisis valuations. The investment generated tens of billions in profits, while providing Berkshire Hathaway with a strategic asset that continues producing consistent returns decades later. Bill Gates has employed similar infrastructure strategies through his investment vehicle Cascade Investment. His portfolio includes substantial positions in waste management companies because garbage collection represents an absolutely essential service that municipalities cannot eliminate during budget crises. people and businesses continue generating waste regardless of economic conditions. Cities must provide waste removal services to maintain public health and safety standards. Gates also owns significant stakes in utility companies that provide electricity and natural gas to residential and commercial customers. These regulated utilities operate under government frameworks that guarantee reasonable returns on invested capital while providing essential services that customers cannot live without. When household budgets tighten during recessions, families find ways to pay their utility bills because they cannot function without electricity, heating, and water. The infrastructure investment strategy requires enormous capital commitments that limit participation to the wealthiest investors. Purchasing railroads, utility companies, or waste management operations costs billions of dollars. But the returns justify these massive investments because infrastructure assets generate cash flows that continue for decades, while appreciating in value as economies grow and populations increase. These three crisis assets, real estate, dividend-paying stocks, and infrastructure, share common characteristics that explain why they consistently make billionaires wealthier during economic downturns. They provide essential services that people need regardless of economic conditions. They generate predictable cash flows that continue during recessions when other income sources disappear. They become available at discounted prices when panic selling creates temporary market inefficiencies. Most importantly, they require cash reserves that most people don't maintain during economic expansions. While ordinary investors chase growth stocks and speculative investments during bull markets, billionaires systematically build cash positions specifically for crisis deployment. This cash positioning appears inefficient during good times because it generates minimal returns while markets are rising. But this apparent inefficiency becomes massive competitive advantage during crashes. The billionaire mindset during recessions operates in complete opposition to normal human psychology. When markets are falling and unemployment is rising and business failures are accelerating, every emotional signal screams to preserve capital and avoid risk. Financial media amplifies these fears with constant coverage of economic devastation. Friends and family members share stories of job losses and foreclosures and retirement account destruction. The overwhelming consensus becomes defensive positioning and cash preservation. But billionaires understand that consensus thinking during crisis moments creates the wealth transfer opportunities. When everyone is selling, someone must be buying. When everyone needs cash immediately, someone with cash reserves can dictate terms. When everyone sees disaster, someone who sees opportunity can acquire assets that will generate wealth for decades. This contrarian approach requires psychological preparation that extends far beyond financial planning. The ability to deploy capital during maximum fear demands emotional discipline that most people cannot develop. It means making large investments when every piece of news suggests those investments are dangerous. It means buying assets when friends and advisors recommend caution. It means acting decisively when uncertainty feels overwhelming. The timing element distinguishes successful crisis investing from premature deployment that leads to losses. Markets can remain irrational longer than most people expect. Recessions can deepen beyond initial predictions. Asset prices can fall further than seems possible before reaching actual bottoms. Billionaires avoid these timing traps by focusing on asset fundamentals rather than market predictions. Instead of trying to identify exact market bottoms, they evaluate whether assets provide adequate returns at current prices, regardless of further declines. A rental property that generates 8% annual returns at today's price remains attractive, even if prices fall another 20%. A dividend-paying stock with a 6% yield from an essential services company continues providing income even if the stock price drops further. Infrastructure assets with regulated returns and long-term contracts maintain their value propositions regardless of temporary market volatility. This fundamental analysis approach eliminates the impossible task of market timing while ensuring adequate returns from crisis investments. The mathematical advantage comes from buying quality assets at prices that already provide attractive returns, rather than speculating on perfect entry points that rarely materialize. The wealth accumulation mechanism from crisis investing operates through multiple channels simultaneously. Immediate income generation from rental payments and dividends begins flowing regardless of asset price movements. Capital appreciation occurs gradually as markets recover and asset prices normalize to fair valuations. Compounding effects accelerate wealth growth as income gets reinvested into additional crisis assets at discounted prices. The time horizon distinguishes billionaire crisis investing from short-term trading strategies. These investments are designed to generate wealth over decades rather than quarters. The initial purchase during crisis conditions establishes the foundation. The income generation during recovery periods builds wealth consistently. The long-term appreciation as economies grow and assets mature creates generational returns. Warren Buffett's railroad investment exemplifies this long-term wealth creation process. The initial $26 billion purchase during recession conditions secured ownership of essential American infrastructure at crisis prices. The annual profits from freight operations generated billions in cash flows during the recovery period. The asset appreciation as freight volumes recovered and grew beyond pre-recession levels created additional wealth that continues compounding decades later. The scalability factor explains why these strategies work more effectively for billionaires than ordinary investors. $1 million rental property investment generates meaningful returns but cannot transform someone's financial position. A $1 billion real estate portfolio purchased during crisis conditions can generate hundreds of millions in annual rental income, while appreciating to multi-billion valuations during recovery periods. Similarly, dividend-paying stock investments work more powerfully at larger scales. Purchasing 10,000 shares of a utility stock during crisis conditions generates modest dividend income. Purchasing 10 million shares creates substantial cash flows that can fund additional investments and lifestyle expenses while the position appreciates over time. The infrastructure investments demonstrate the most extreme scalability advantages. Individual investors cannot purchase railroads or utility companies or waste management operations. These opportunities require institutional scale capital that only the wealthiest investors can deploy, but the returns from owning essential infrastructure assets justify these massive capital requirements through decades of consistent cash flows and strategic value appreciation. The next recession is coming. The only questions are when and whether you'll be ready to profit from it. While most people will panic and lose everything they've worked for, a small group will become dramatically wealthier using these exact same strategies. The 3 crisis assets that made billionaires rich aren't secrets anymore. You know what they are. You understand how they work. The question is whether you'll have the discipline to build cash reserves now and the courage to deploy them when everyone else is paralyzed by fear.